Welcome to episode 2, season 2 of the Altogether Show. Today, we're joined by Michael Sidgmore, co-founder and partner of Broadhaven Ventures, where he invests in early-stage fintech companies globally. Michael is also the founder of Alt Goes Mainstream and has his own podcast, Community Times Capital, and he hosts that alongside Alexis Ohanian. I met Michael back in 2017 when we were just launching Alto, and he is clearly a thought leader in the alternative asset space. Please enjoy this conversation that we had not too long ago. Michael, welcome to the show.
Eric, thanks for having me. It's an honor to be here.
Thanks for being here. So, I just gave people sort of the professional background and outline of who Michael Sidgmore is. But if someone's getting to know you and they say, "Hey, Michael, tell me who you are, tell me about you," how might you reply?
That's a great question. Look, I think there's the kind of the personal side and there's the work side. I do think those two things blend together because I do feel like that I am lucky in that what I do every day for work is something that I love doing. So it honestly doesn't feel like work. Working with founders as a venture capitalist at Broadhaven, which I co-founded with my partner back in 2017, Greg Phillips and I co-founded the fund. We do this because we love it and we love working with founders. We've both been on the other side of the table. So I think, who am I? I mean, I think it's when it comes to like the work side of me, it's really, I'm somebody who loves the process of entrepreneurship and building companies that create an impact in the world, reach millions of people, touch their lives, particularly in financial services, which really kind of the world, whether we like it or not, revolves around money, right? And it's what makes the world go. Community may be what keeps it turning. That's what Alexis and I say on our Community Times Capital podcast, but money is what makes the world go around. So being able to help build companies every day that actually impact people's lives directly or indirectly is something that I really enjoy and love spending my time on. And that's what kind of consumes my day. And I think, from the personal side, I think that's why in many respects, I am a VC. I love helping people. That's like something that just comes naturally to me. It's who I am. And there's nothing I'd rather be doing in that regard than helping people realize their dreams and build things that they want to build for the world.
That's a great answer, by the way. And not that there's a right or wrong answer, but I love your answer in terms of who you are. And, it seems like every time we speak, whether it's, over the phone or via text or email, you're between locales. Where are you today? Where are we doing this podcast?
So I'm in London. I'm in quarantine for the next few days. I'm at my uncle and aunt's house in London, and I came here for something very special. I couldn't pass it up. First of all, it's amazing to be able to see my family. Really lucky to be able to do that. I saw them pre-COVID, but I really kind of grew up with my little cousins here who are now 2 weeks away from going to college. And wow. When I went to London back in 2007 and lived here for 5 years, went to university to undergrad at LSE. And my little cousin, Sarah, she was 5 years old then. So I would babysit her all the time. And we had this really special bond just from spending a lot of time together and watching her grow up. I mean, I watched her grow up for 5 years. And now, she's literally about to go off to college a few weeks away. So it's really special to be here for family. And it was I had a great excuse to drag me out to be able to be here, which is that one of our founders, woman named Victoire Kojavina. She runs a verticalized online community for football fans, and she texted me amongst a few others and said, "Hey, I have tickets to the Euros, the semifinals and the finals. I couldn't turn that. As a former footballer, aspiring footballer myself, I couldn't turn that down. So here I am. We'll see. I got to make it out of quarantine, but assuming that goes well, then I'll be at the Euros."
Well, that's indeed exciting. And so where are you from originally?
So I grew up outside of Washington, D.C. in Maryland. Went to high school in DC and kind of really grew up my entire life there. Ended up traveling a decent amount for soccer. So played soccer and was lucky in that took me around the world. I mean, I played in tournaments in Argentina, Australia, Rome, all around the U.S., which was a lot of fun, and that kind of got me seeing places all over the world. And then we went actually my club football team in the U.S. Went and played over in the U.K. and played some English Premiership youth clubs. So I credit one of my coaches who was English for kind of exposing me to the UK and really made me fall in love with it. And that's a big reason why I actually ended up there for undergrad. So went to undergrad at LSE, did a year at Middlebury, kind of after doing a gap year in the UK. Initially tried to play soccer over in the UK, did a gap year, ended up getting injured, a few hip surgeries, and worked for a nonprofit in the UK called Room to Read, where I just literally read the founder's book, Leaving Microsoft to Change the World. This guy who built this incredible international literacy NGO, a guy named John Wood. And Cole reached out to him and said, "Hey, what can I do to help? I'm on this accidental gap here. Would love to work for you and help build Room to Read." So ended up doing that and really kind of fell in love with London. Knew what I wanted to study at that point. So after a year at Middlebury, went to LSE and did my undergrad in London. So that was really it's nice to be back here because that was really formative for me in terms of kind of shaping my outlook on the world and just really kind of being in an international environment. I was one of 2 out of 200 kids in my class of 200 people who was actually an American. So I was very much in the in the smaller group of people who were familiar to me. So I really had to kind of go out of my shell and meet a lot of people, a lot of friends who were international as a result. So I grew up in Maryland in some senses, but I also grew up in London in a lot of other senses.
So for those who are just listening and not watching, you're wearing an Angel City FC sweatshirt. Can you tell the audience about Angel City FC a little bit?
Yeah, so well, as a huge football fan, this has some significance for me. So Angel City is the new women's football club in Los Angeles. It was founded by a group of tech executives, entrepreneurs, and venture capitalists. So Julie Ehrman has been a tech executive for quite some time in the gaming space. She came together with Alexis Ohanian, who co-founded Reddit and then initialized and was one of the lead investors in Angel City, along with Kara Nortman and Natalie Portman. So Kara Nortman's at Upfront VC. Natalie is an actress. And they came together and said, let's build a women's football club for LA that really stands for impact, that's a purpose-driven brand, and that can become a global brand. I think that's what's so cool about Angel City. I was actually part of their clubhouse earlier this week where they launched, and they're launching an NFT that will be fractionalized into 5,000 pieces, enabling fans around the world or in LA to own a piece of their club crest digitally through this non-fungible token that they were allowing people to invest into. And I think, when you think about the innovation in sports that's possible, I think they haven't even fielded a team on the pitch yet. They're coming into the NWSL in 2022. But I think what they stand for is really 2 things. One is how incredibly underrated women's sports is. The brands that have started to affiliate themselves with the NWSL, so brands like Nike or Visa, which has affiliated themselves with the women's national team, they've seen massive uptick in brand engagement from women's soccer or fans of women's sports as a result of affiliating themselves with women's leagues, teams, and players. So I think that's a fascinating data point into the window of women's sports and how insanely underrated this is, which is why, Alexis has said this a lot. We've talked about it on our podcast, Community Times Capital. This is a huge opportunity to bring people together in the community and build a team for the community in a way that hasn't been done before. And I think that's what Angel City is doing. So that's why I'm happy to represent what they're doing in that regard. And then I think the other piece of it too is I actually wrote a blog post about this, released it yesterday, called the Sports Stack. So that's kind of investing across the various layers of the sports stack. I call that teams, players, and fans. And now we live in a world where you can monetize engagement. And I think that whether you're investing in sports teams to own equity, like Alexis Fund at 776, and Angel City, and Initialized, an investor in, and then players investing into sports cards through companies like Alt. I'm an investor in So Rare, which is kind of a digital NFT or collectibles platform that's combining fantasy football with the ability to collect and trade and invest in sports cards with football players or soccer players. There's just so many opportunities to monetize engagement in sports, but also think of it as an alternative investment, whether you're investing in actual equity of companies or investing into collectibles, physical or digital, and monetize that. So I think that's the other piece that Angel City represents, is this kind of whole new wave of alternative investments that of which they are part of, and is kind of the new wave of investing where people want to own things, and they want to not just own things, but own things that they are passionate about and interested in. And that's, I think, the collision of culture and investing, capital, that makes this time in the alternative space so exciting, because you're really seeing culture become investing. Investing is also now cultural significance. People want to invest in things that they like. They want to share it with their friends. So I think we're just in this really interesting time in the world of investing, particularly in the alt space. And a big reason why I launched the Alt Goes Mainstream content platform is because I think that it really truly has gone mainstream, whether it's sports or crypto or alternative investments into startups. People want to be a part of this movement, and they want to have ownership in it.
I mean, you're preaching to the choir, and I think it's it's really interesting if we use Angel City FC just as a model for the larger alternative asset movement, right? So women's sports for a really long time, I think the reaction was, oh, that's nice, right? And what we have seen over the last really kind of 20 years is that it's way more than nice. Is that women are unbelievable athletes, just as men can be. And they put as much out on the fields and deliver as much in terms of entertainment and excitement.
I don't see how the women's game can't become more popular. And it's a massively underrated opportunity as a result of that. And I think the reality is, again, it goes back to brand engagement and the ability for brands to reach end consumers who want to have certain types of content. They want to have purpose-driven content. And this is not just about the women's game, but it's the WNBA, the NBA, the NFL. If you see them all over the past year, they started, the players, not necessarily the teams, to some extent the teams, the players started movements. And people want to follow movements. These athletes are more than just the names on the back of their jerseys. They're cultural icons. They actually did that this year in the bubble, right? In WNBA or NBA, they had names. They took their own names off the back of their shirt.
Took their own names off.
They were like, say her name, equality, things of that nature, which are social justice movements. And I think that represents something so powerful, which is these players are willing to forego their own commercial identity, which is the asset that they have. That's their biggest asset in their life. That's their biggest kind of career earning potential. And yet they were willing to forego that for something bigger than themselves. And there's data that shows that purpose-driven content is incredibly more engaging than general content. And I think sports teams have realized that. And sports teams are effectively vehicles for brands. A friend of mine, Mario Gabriel, he wrote a great piece on Red Bull with a company. They did $7.4 billion in revenue in 2020. They don't produce a single asset of their own. They have sponsorship of a lot of those assets, and they spend billions of dollars on marketing. But that's a $7 billion a year revenue company. And they don't produce their own assets. But what that shows is you can build an incredibly powerful brand that people want to identify with if you strike the right chords and hit the right tones to market to people who then want to be a part of that brand or affiliated with it. And I think sports teams that figure that out and end up investing into that will then reap the rewards as businesses, and they will look very much like growth companies. I mean, Joe Mansueto, the founder of Morningstar, investor in Chicago Fire, he said exactly that. He said a few years ago when he purchased Chicago Fire for $400 million, he said, I'm investing in the MLS because it's very much a growth company. It is not where it is today, but it's where the puck is going. And that's going to be appreciation value in the collective value of all the teams, the league, and then the teams themselves. And I think that's what people see. Why can't these brand properties be massive global brand properties and really big businesses in their own right?
That was part of the brilliance of the way the MLS was set up at the beginning, by the way, which this may be the slowest growing growth company, but I agree that it feels like it's on the verge of hitting an inflection point here. But it was set up for the collective to win rather than just one particular team or brand in any single major metropolitan area.
Yep. And, I mean, it's teams in areas like Seattle, Portland, these not necessarily kind
Nashville
of
now.
Nashville, that's right. But like these cities that are great sports cities have rabidly passionate fans who want to invest in the team and invest in the game, and may not have all these other tier one sports clubs or leagues in their city. So I think that's a huge opportunity. Honestly, in some ways, becoming a new entrant in the sports world right now actually might be a very fascinating time to do so, because you have the advent of esports, which is interesting. You have all of these changes in media, right? OTT media is completely changing the game when it comes to kind of defeating linear media, right? So like cable TV, broadcast, etc. Still big, but people want to watch games on their own time, in their own terms, in their own ways. They want to engage differently. They may not want to go to games. So like there's been a secular decline in ticketing sales, in-game ticketing sales. So teams need to figure out how to make money now. And that's going to be in different ways. That's going to be through merch. That's going to be through branding. That's going to be through putting the player first. I think that's another big thing that I think Alexis said this on the Clubhouse the other night, that people want to, like, the players are who people want to identify with. And it's about putting the players first because they are the ones with the reach and the icon. I think Alex Morgan has 9.2 million Instagram followers. That's more than Microsoft and Amazon combined. That's like, could you argue that
she's fast and can score?
Exactly. And so she has an on-the-field product, but she also has an off-the-field product, just like LeBron James. I mean, LeBron has 88 million Instagram followers. And to think that like these people can't monetize that engagement in some way in today's world is, I think, something that I certainly wouldn't bet against. And neither should teams and leagues. And they should leverage that and enable their players to help them bring in fans if it's player-led first. And if you do that, I think you can create some really interesting brand engagement tools, which then create various types of investment opportunities, whether it's investing in sports cards, whether it's players investing in their own sports cards or what they're doing on the field, whether it's teams investing into players or fans in various ways, and then enabling people to invest into teams. I mean, I think we'll see more crowdfunding opportunities for investing in teams. Republic had fan-controlled football on their platform. WeFunder had Detroit City FC, which is a lower level.
I think they also had Knoxville or Memphis, maybe.
Yeah, I think they may have had that as well. And like enabling fans to have a piece of ownership of a club they support, own equity, shows that you can then start to create kind of this virtuous cycle around commerce over time. So I think we're going to see all these things happen in the world of sports. And that's where I think I can't say I'm an expert in the sports world, but that's where it kind of clashes with the world of alternative investments. And that's where I think you're going to see this really interesting overlap. And that's why I've called this a really interesting alternative investment opportunity.
So perfect segue. You did it for me. Because you were just talking about, owning a piece, a minority interest, the fractionalization of securitization. How is that playing out? Where does that fit into the alt goes mainstream global thesis?
Yeah, so I think fractionalization is a big piece of the alts movement writ large. And I'll get to that in a few ways. So I think if we think about the evolution of crowd capital raising platforms, that's been a big driver for this trend. So first you had the donation-based crowdfunding platforms in 08, 09, Kickstarter, the likes like that are enabling Indiegogo, that are enabling people to invest into projects. They may not get equity in exchange for that, but they get something in return for it and they support these projects. That got people, I think, comfortable with this idea of crowdfunding a project. That's since transformed into various types of crowd capital raising platforms. I was a part of two of them. I was the first sales hire at Mosaic solar finance platform, which originated residential home solar loans, done about 7.5 billion of home solar loan originations at this point. And then I was early at iCapital, was employee number 8, helped build the investor network there. So building off the kind of family office wealth management network there and enabling investors to access alternative investment funds, private equity funds, venture funds, hedge funds at lower minimums than they would normally be able to invest into a Silver Lake or a Warburg Pincus, things like that. And in seeing both of those platforms, I think there's some interesting trends around just kind of almost fractionalizing pieces of ownership or minority ownership in many of these different assets, whether they're solar projects, whether they're startups, whether they're venture funds, private equity funds, late stage private companies. And then I think now we've gotten to a really interesting place in the alt space. This is kind of the next wave, which is that culture has become an asset class. So now you can financialize other types of assets. I call them alts. So things like sports cards, collectibles, which Rally Road is doing. Alt is doing this for sports cards, enabling people to transact, buy or sell sports cards on their exchange. And I think fractionalization or platforms that are building the market structure across the life cycle of a trade. I come from a market structure background. That's where I started my career at Goldman, investing into fintech companies that were really kind of capital markets based. So think about kind of pre to post trade. We now have a lot of the infrastructure that's enabling that to happen, right? So enabling people to find companies or assets that they want to invest into, be able to value them through some form of market data that either the platform is providing through either vetting or just the data that they have, and then being able to invest and execute a trade, and then being able to own one of those assets. And then post trade, there's custody. There's not really clearing in this market yet, but there's custody of those assets on the platform. And then there's the ability to, in many cases, have a secondary market to trade those interests if somebody needs liquidity. So I think all of those pieces of market infrastructure is being created thanks to innovation in fintech. And what that's doing is I think that's enabling people at smaller sizes and scale to be able to invest into this thing. I don't think I could kind of end this little soliloquy without talking about how public markets companies have actually helped to indoctrinate people into the idea of investing. So whether we like them or not, companies like Robinhood or Public, which are enabling people to invest into public equities, is making people think that they can now invest, they can now own. I think what's fascinating about the alt space is that these are not just things that people want to invest in for monetary purposes, but they're passion or interest-based investments. And it's the combination of those things that something they care about and may actually understand deeply. Somebody who's a classic car expert may actually understand classic cars better than they understand how to value Microsoft as a public company. And if they have a chance to invest in that asset, they may actually know what they're doing and be able to make money on it. And now through a platform like Rally Road, they could do that. Or same with a sports card on alt. They might know LeBron James really well and understand why or how one of his cards, after collecting for 20 years, might be the right card to invest in. So these platforms are enabling that to happen. And I think that's a really exciting development for the alt space.
So, I mean, you touched on so much there. So great soliloquy, by the way. It was fun to listen to. And I want to see if I can't tie a couple of those pieces together. So specifically Robinhood and Public, by the way, they have brought a cultural and a passionate aspect to the investment activity. Some people will say it's, uninformed trading potentially, but, it really makes me think, if we go back to the fundamental financial models of value as we know them, and there are business schools and economic classes and all sorts of other educational coursework that's created based on fundamental analysis, right? And discounted cash flows and growth rates and how to pull a net present value of an expected future together and what that may be. And what I think we see happening to a certain degree, is a recognition of what those of the sort of past metrics may have been, as well as a new pronouncement, if you will, of what analysis looks like for the future. And the two things are entirely different. I can't remember what it was, but or where I got this. I think it was from First Things, but the idea that knowledge has a half-life, right? And so fundamental analysis and what it means for a company to grow and what that growth rate will be, and therefore what it's worth today, has been the way we determine value for the last, 80 years. That may not be the way we determine value for the next 80 years.
Yeah, I mean, there's some really interesting points in there. And I'm not, while I am certainly a believer in alts, I am not blind to a few things. One is that we are living in a low interest rate environment where people want yield. So that may change things in alts over the short term. However, I do think over the longer term, people want to invest into things that they really care about and understand and are passionate about. As a result of that, I do think there's a longer term secular trend towards investing into these types of assets. I also think people want to own things and have an ownership in something. And that's because that's a great way to build wealth over time, assuming that you're investing in high quality assets. Now, that's where I think the platforms have a real responsibility to put high quality assets on their platform so that investors are investing in high quality assets, whether they're a non-accredited investor or an accredited investor. And I think we are starting to reach that point. But I think that's another important feature of all of this. Now, I do think that, look, I mean, productive assets exist for a reason. They produce cash flows. You can value them. They provide dividends that enable investors to reap some benefits. They also provide the ability for companies to reinvest some of that growth back into the business to create more value with that business. Now, I understand that many of these assets are speculative assets in the alt space. However, I don't necessarily think that's a bad thing. And here's why. The reason why is because if you think about the high net worth portfolio, they have not been investing on a 60-40 portfolio for some time. They've been investing into things like art, which is a speculative asset. They may be investing into things like classic cars, watches, collectibles, memorabilia, even sports cards. I mean, there are sports cards that transact for multi-millions of dollars at this point, right? So people who are in the high net worth category have been investing into these assets. They now have better liquidity mechanisms. I think that's a really interesting development for this space where those assets can be fractionalized through platforms like Rally or Otis or Collectible, and then brought to the public through a quote unquote IPO. And then the public can invest in it, and that may increase in value over time too. Even if they're buying it at a relatively high price, but that liquidity mechanism creates a different kind of framework for these assets than we've seen before. But the high net worth community really hasn't been investing in a 60-40 portfolio. And I wrote a blog post about this recently on Alt Goes Mainstream, saying that I think the 60-40 portfolio is no longer. Because if you can enable people who don't have hundreds of millions of dollars to also invest in some of these other assets in a prudent way, but have exposure to some speculative assets. Crypto is another example of that, where in certain cases, assuming people are well informed or understand things, investing and having some exposure to crypto and having the potential asymmetric upside of you can only lose whatever you put in. If you put in $1, you can only lose $1. But if it goes up 10x, you stand a chance to make 10 times your money. Then it may be good for people, assuming they're able to lose what they're putting in, have some exposure to speculative assets. And I think that that's the world we live in today. And that's why I think many of these alt platforms, A, are a good development for the space, and B, they're something that people should have some level of exposure to in a way that they feel comfortable with.
So we went almost 40 minutes without saying the word crypto, which I think is actually pretty good in today's day and age. And there are a couple of things that I want to talk about. And actually, I just want to raise and then let you talk about actually. So one is adverse selection. You were talking about the quality of assets that a regular individual like you and me can find for investment purposes on some of these investment platforms, crowd platforms, whether it's Rally, Otis, Collectible, whichever it may be. Where are we on that adverse selection curve is sort of my first question. And then, because I agree with you on all of this already. And the second question is, did we start in the right place with the Jobs Act Title III and Reg CF?
Those are both great questions. So I'll answer the first one first in terms of quality control on platforms. I thought a lot about this when I was at both Mosaic and iCapital and investing in a number of these platforms. At Broadhaven, we invested in Republic, which has thought deeply about this as well. And look, I think that 4 or 5 years ago, I think there would have been some adverse selection bias on both sides. So companies or issuers who are putting their assets on these platforms would have been apprehensive about doing so because of the perception that this is the platform of last resort. This is where platforms or issuers who can't raise money from other places are going to be able to raise money from the crowd. I think that perception has changed, and I'll give you some concrete examples. So Republic, recently, they had 2 companies on their platforms, Beacons.ai and Maven, both of which are venture-backed. They raised a prior round on Republic in addition to raising from VCs, traditional brand name VCs. Both of those companies in follow-on rounds raised capital from Andreessen Horowitz, a top Silicon Valley brand name venture capital fund. I think if you had seen that a few years ago, we would have been incredibly shocked. I think now that is becoming more commonplace because I think that on many of these platforms, particularly platforms that care about community and engaging community, like someone like Republic does, this isn't an or proposition. You don't have to raise capital from the crowd or from VCs. You can do both, and it's actually a really powerful tool because what you're doing is you're enabling the community to participate and become an owner. And there's data that shows when people are owners of a stock, they are more likely to actually consume goods from that company than they are from competitors. So there's actually a good business reason to engage the crowd or your customers as owners and evangelists, because when they own things, they'll be more rabid evangelists about it. So I think we've reached a point where many of these online investment platforms are and platforms, not or platforms. You can do both. And I think that's a really, really good thing for the space, because what we don't want in this space is we don't want blowups. We don't want poor quality on these platforms, because the reality is any of these platforms, whether it was the lending clubs and that era of these online marketplaces, or today's world of the alt space, whether it's investing in startups, crypto, sports cards, collectibles, there is that inherent tension that any marketplace has in terms of balancing number of listings they have versus the quality of those listings, right? Because, and especially if they get compensated through volume, right? And the number of listings that they have and that they fill. So there's always that balance that companies are going to face from a kind of marketplace dynamics perspective. But the fact that high quality companies are going on platforms like Republic, I think is a really strong signal that we've reached a point in the evolution of crowd capital raising platforms or online investment platforms that good companies can raise on there and raise capital from both the crowd and traditional investors. And it's a good thing for both sides. So I think we have hit that point. And that was, seeing that with Republic, that was a big part of our thesis, was that there's going to be enough great companies who want to raise capital on Republic because they see the value of community as an enhancer to what they're doing. So I think that's here to stay. iCapital has tons of blue chip private equity funds and hedge funds on their platform, and they just view this as an additional channel to go after, because the reality is there's not a ton of net new pension funds, endowments, sovereign wealth funds that are being being created, but there are hundreds of thousands of net new accredited investors who are being created every day. So that channel, along with the independent wealth management channel, the RIA channel, the RIA channel itself, fastest growing segment of the wealth management channel. There are more assets in the independent RIA channel than there are at wirehouses, which is private banks. So wirehouse means UBS, Morgan Stanley, etc. And that is a huge development for the alt space, where these investors, individuals or intermediaries, need access to product, and these platforms can provide access to high quality product provided they're vetted. So I think that hopefully answers question one. Question two on, did we start in the right place? with Reg CF and things like that. Look, it's a good question. I think that the increase in cap and size that the regulators created more recently with 1 to 1.07 million for a Reg CF raise, which is what many companies had to adhere to if they wanted to raise from non-accredited crowd investors, to now $5 million, is great because it enables more crowd participation. Now, I think there are things that actually the UK has been incredibly innovative in, which potentially other jurisdictions can learn from, which is the UK actually has kind of been a bit ahead of the US when it's come to crowdfunding. Platforms like Crowdcube and Seedrs, you could actually invest into any crowd offering on one of those platforms, even if you were non-accredited, provided that you were only investing a certain portion of your net worth. And I think that's a good way to do it too, because whether you have $50,000 to invest, $10,000 to invest, $500 to invest, if you could invest a portion of that and you're investing it in a high quality company. I mean, look, Revolut and Monzo raised on crowdfunding. Those are now multi-billion-dollar digital banks, and those investors, even if they invested $100, would be up hundreds of times their capital, right? And that, even if it's $100, that would be incredibly meaningful to them. So making sure it's limited to, again, what people are able to lose. So whatever they're willing and able to lose, I think that's okay. But the reality is, and I don't want to equate investing to gambling, because I think those are two different things, or can be two different things. But people are allowed to gamble and they're allowed to buy lottery tickets. Why can't they invest in something that, I mean, in theory, companies are productive assets. Not always, but companies are productive assets as they grow and become profitable and have cash flows and all that. So why put that money into a lottery ticket where, 90+% of the time you're probably not going to come away with anything?
99+% of the time you're not going to come away with anything.
I'm sure. But you may come away with something with a startup, or at the very least, like that company may create an impact in the world. And I think that's something where I hope there's a mind shift there, because investing into things that actually build things is never a bad thing.
So on the raise of the cap in Reg CF from 1 million to 5 million, I agree it enables greater participation. I also think it does something else which is really strategic, which is that it allows institutional investors, it allows funds, people that do this for a living, to participate in rounds, because I agree with you, it's no longer an or, it's an and, right? You can have both VCs and retail participation. And so if a fund can come into a round because it's a $5 million round early, they can provide strong signal to the rest of the retail marketplace to say, hey, I can do a certain level of diligence on my own, but I expect that Michael and Broadhaven are going to do that much more diligence before they write a $2.5 or $3 million check. And I I'm already passionate about this company. I love the product. I'm going to be a consumer, and I like Broadhaven's track record, and so I'm going to participate with them. And so I think that's also really important. One of the questions I have, and part of where I was trying to go with this was, we do not allow not yet accredited investors to invest in funds. Mm-hmm. That seems like so. If I were to do Reg CF over.
Yep.
I would start with funds and then expand into, individual companies. Any thoughts there? Or?
So yes, great point. I agree. I think funds are a great way for people to get access and exposure to the alts world. But in a way where it's a specialized or professional manager doing it. Now, again, I think you have to be careful with funds, because you'd only want to be in top quartile venture funds, because the interquartile spread, meaning the difference between first and fourth quartile funds in the world of venture, like if you're not in Sequoia or Benchmark and a handful of others, now there are plenty of great emerging managers coming up too, but you're in a fourth quartile fund, it will not have been worth doing venture. You might as well just put money in an index fund.
That's right.
But if you're in one of those top funds or investing alongside of those funds into a great company that they invest in, then I think it can be worth it to do this. So I totally agree with you that people, if they could have access to funds, that'd be fantastic. And I think that we're starting to see that happen a little bit. There's still some kind of regulatory hurdles, or it's just hard to do for fund managers to do this when they want to aggregate retail capital into their fund. Now, a few things. One is in the UK, that's actually become possible. So Passion Capital was actually one of my guests on the All Coast Mainstream podcast. Eileen Burbidge, who's one of the partners there, came on and talked about how they actually did a capital raise for their Fund 3 on Cedars. And you could invest £100 and you could invest into Passion. And they raised, I think, £3 million and had significantly more demand than that. They initially set out to raise and reserve £1 million for their fund because their fund was basically closed and they just wanted to leave a little part for the crowd. And it is happening in other jurisdictions. I mean, Passion's one of the best seed investors in the UK, if not Europe. They invested in Monzo very early and a number of others, and they've returned multiples of their fund, right? So that I think is incredibly powerful when it works. Now, the pushback, though, on the other side is twofold. Not that I don't agree with you, because I do. I think people should have access to funds, and funds, like these are people, particularly in the alt space, in many respects, networks matter. Knowledge matters, and information asymmetry matters in a totally legal way. And those are things that professional fund managers have, not individuals. So that's where I do think investing in funds make a lot of sense, because they should, in theory, if they're good at their job, outperform relative to an individual picking on various crowdfunding platforms. Now, the other side of this would be, one, it removes the passion and ownership element in a sense where people are not as directly tied to that asset. And I think, some people may not want to participate if they're investing through an intermediary, i.e. a fund instead of directly. The other piece of it too is you can almost by proxy, assuming that the companies that people are investing into are companies that would be backed by some of these top funds, you can almost get proxy exposure to some of those funds through investing into those companies. So if you'd invested in Beacons or invested in Maven, you'd have by proxy some exposure to Andreessen Horowitz. Now, again, if those two companies don't work, then it wasn't worth it. But and in venture, that's often the way it works. There are a small number of companies that work and drive a fund's returns versus the majority that don't. But I do think that's the kind of pushback on the other side. Now, I think that, again, this is an and, not an or. People should have access to both funds and direct deals, not just direct deals. Because I think, to your point, it would definitely be safer if people had access to funds. And I think that would be a good thing writ large.
So I'm not a huge proponent of SAFE, by the way. I am a huge proponent of homework and diligence. It just seemed odd to me that we would allow people at the outset to go try and build their own portfolio, as opposed to, learning from someone who's doing it day in and day out. And so, we have a lot of listeners who are trying to do this for themselves. And you've been doing this for a while. So if you could provide, just sort of 3 points on diligence, can you talk about where you may suggest someone start doing their homework? And what they should be thinking about, what they should be looking for, who they should be talking to before they decide to make an investment?
Yeah, sure. And I think this will depend on the platform. So the first thing I'll say is, if there's something that you are really knowledgeable about or passionate about, particularly in an area of an alt, like collectibles, classic cars, wine, sports cards, you may know a lot about that space. And you may actually have some level of knowledge that gives you a quote unquote edge. So that's kind of the disclaimer here, but generally speaking, and I'll kind of take a framework that we try to use as professional investors. But one is, and I'll have to caveat this because I think the one thing that people generally can't get access to is the team. But I think as an early stage investor, we look at the team as being an incredibly important piece, an ingredient to the success of an early stage business. They're the engine that drives growth. They're the engine that hires. They're the engine that raises capital. So that's one thing that we look at very closely. Now, there are ways to discern on paper whether or not this team may be better suited for building this business or not. I think that can be hard without meeting the team. That's one thing we look at. But removing that, I think that, look, if somebody has, I tend to like investing in what I know. That's why I do fintech. Now, fintech is very broad for us, but and I've learned a lot from investing in other things. But I've tended to find that investing in what you know ends up helping you better understand the opportunity that you're looking at. So one would be, if you're knowledgeable about a space, I think that can be very helpful in looking at a certain company or investment, and can be a good way to think about, like, is this something I'd want to invest in versus something maybe I don't know? And where I've tended to make mistakes is when I haven't known enough about something and thought, oh, this looks great because on the cover it looks awesome. But then you open up the book and you realize you don't know a lot and there was a lot you missed because of that. Whereas investing in something that known, I was able to kind of know much better whether or not this is going to work or not. So I think that can be very helpful. And I think the benefit of these crowd capital raising platforms is there are people with various experiences, various backgrounds that actually can help them discern an investment and even potentially help. I think over time, you're going to see these crowdfunding platforms create networks that can actually activate and help certain companies based on their backgrounds. And that, I think, is a really valuable piece of this. So I think that's piece one. Two is understanding, kind of the fundamentals of the business, I think ends up being very helpful if it's a company. Now, if it's a sports card or a collectible, I think that's a little bit different. And you have to kind of evaluate it on a different scale of metrics. But when it comes to investing into a company or a fund, then it's, what are they building? Is this something that's needed in the market? What's the problem they're solving? What is their solution? Is their solution different? And then where does this fit kind of in the broader mosaic of kind of other people who are playing in this space, incumbents or startups as competitors? So if you kind of go through that framework, that can help you figure out, is this the right type of opportunity? And then I think, and then I think it's about sizing it properly too, right? So that's the other piece of this as well, is investing in something where you feel has potential upside. That's great, but make sure if it doesn't get to where you want it to be willing to be comfortable losing 100% of what you put in, while potentially standing to make much more than that if things work out. But always know what your risk is when you're going into something like this.
And this is why I like to talk about portfolio diversification and that ability to balance risk and reward, and just expect that by going away from 60-40, whether you can do 10 by 10 or 5 by 20 or whatever the case may be, you're reducing overall volatility while increasing the potential for return. So to just, kind of close the loop and bring it back to sports, because, well, I like to talk about sports and where the puck is going, of course, as the analogy. What can we see? What do you have any expectations around what we're going to see in college sports now that the rules are most definitely changing there?
So first of all, I think athletes should absolutely be compensated. They are, at many of these D1 schools, effectively professional athletes, just without any of the ability to monetize.
Yep.
I think we'll see a few things. One is, I think we might see athletes actually stay in college a little bit longer if they are able to monetize, which in some ways may actually be good for them. I mean, if you look at certain positions in the NFL, they are actually more prepared the more years of experience they have in college. So it can be a good thing for players if you think of them as, them as their business. And if they end up getting drafted higher as a result of that, then they're going to make more money, or they'll get a better contract in the future because they play better once they get in the league. So I think there are definitely some net positives to this. It's probably a long time coming in that regard. I think the other thing that you may see, and we're starting to see this in professional sports as well, is just the ability for athletes to connect with their fans and be able to monetize from that. I would hope that just like professional leagues allow players to monetize engagement, I would hope that there's ways for college athletes to monetize that engagement. I think social media is an incredibly powerful tool. And there are college players, professional players who have millions of followers across their social channels. If they are able to leverage that, they have a product themselves, plus the things that they may like or want to promote. They should be able to benefit from that because they're the ones doing the hard work on the field, and they have a brand because of what they've done as themselves, as a business or as a creator. And I think this applies to any creator. I mean, we're living in a world and a time where creators and the individual is decoupled from the institution. So I don't see why individuals, whether they're college athletes as creators, professional athletes as creators, other types of creators, writers and Substack, YouTubers, etc., they should all be able to communicate directly with their fans and be able to monetize that engagement because they are the ones doing the work. And I think if we see that kind of play out, I would love to see college athletes be able to be able to be compensated for that. And the other thing too, if we do believe in a world where players are able to monetize engagement, it's not just what they're doing on the field that's important, but it's what they're doing off the field. And by the way, they could get dinged in their kind of in their on the field life, as well as all the business activities they have off the field if they do things wrong off the field. So I think there's actually some positive externalities that come out of this world. But if players are actually learning about how to engage with their fans while they're in college in a kind of meaningful, deep way, maybe even academic way, I think it's only going to help them when they get to the pros, because that's their platform to be able to engage fans in things that they care about, or just broader social movements, which I think is a really good thing.
Last question. When do we stop calling them alts?
When they've gone mainstream.
There you go.
So that's the hope, is that hopefully soon that, I think, alternatives has been a catch-all for many types of investments that are not traditional public equities or fixed income. I think, look, whether or not they're called alts, I think they deserve a place in investors' portfolios. I think the actions are bearing out such that people want to invest in these things, and they're having a place or earning a place in investors' portfolios. As a result of that, I think they are going mainstream. Will they ever not be called alts? I don't know, but in some ways, I don't really mind if they're called alts, because as long as they've gone mainstream and end up in an investor's portfolio, assuming they're high quality assets, I think that's a good thing for everyone.
Hey, Michael, thanks for spending the time with us from London. And I hope you enjoyed the Euros, and I hope England does well first against Ukraine and then whoever is next.
Fingers crossed. I'm hoping England can make the finals, because it would be pretty cool for the country to have their team in the finals. So I appreciate that. Thanks so much for having me. Really enjoyed the conversation.
The Altogether Show is brought to you by Alto. Alto knows that achieving true portfolio diversification means investing in more than just stocks and bonds. That's why Alto developed a streamlined platform to make it easy and cost-effective to invest tax-advantaged retirement savings in alternatives, assets like real estate, venture capital, and crypto, that are outside of the public markets and available through Alto's growing list of investment partners. To learn more, visit altoira.com/altogether.